Let's do the numbers. In a nutshell, at the end of the third quarter, U.S. stocks remained on divergent paths. International stocks are still suffering. Bonds are doing quite well due to the drop in interest rates. The lineup: U.S. large companies are up 6%, but U.S. small companies are down 9% year to date. Overseas companies are down 5% year to date. The return from bonds remains high at 7% due to the drop in interest rates. The third quarter was marked by a ragged reopening of small businesses, of schools and colleges, of tourist and transportation sectors. We are rapidly learning to fine-tune our efforts, use earlier bar closings, don't shutter all non-essential businesses, to enforce broader compliance among an independent populace, and to speed up therapeutics and vaccines. Third quarter also had activism in the city streets advocating fair treatment of minorities, and of course, this election and politics. All impact our economy, all impact the perceived level of uncertainty by which businesses and investors make decisions for the future. What matters most? Corporate earnings and interest rates. The Federal Reserve intends to keep rates low until 2023. Markets love that. Corporate earnings likely get further stimulus, government aid, vaccines, and a return to some reasonable economic normal close ahead. U.S. GDP dropped 5% in the first quarter. It dropped 32% in the second. Projections are for a 24 to 35% sequential rebound in this third quarter, followed by a 3 to 5% benign growth in the fourth. Bottom line, we'll end 2020 with a 3 to 5% overall GDP contraction. Compare that to 2019's growth of 2%. We have a rapidly shifting economy with some sectors contracting and some sectors expanding, both at time warp speed. Compare the 24% return on the NASDAQ index, heavily weighted with tech stocks, to the 5% return on the S&P 500 of large companies. By the way, that S&P 500 has some tech stocks too. Who benefits? Amazon. Who loses? Ruth's Chris Steakhouse. Who benefits? Home Depot. Who loses? American Airlines. Some of these changes are temporary, but many are not. Will we ever need as many office buildings again? The stock market is richly valued based on trailing earnings, of course, but what about forecasted earnings? Well, price-earnings ratios are still high when calculated on the next 12 months' earnings. Market breadth is rising, meaning that all stocks, not just tech, are starting to appreciate. Don't forget expected stimulus. Don't fight the Fed. How do you invest in this cacophony? Remain diversified. Don't bet on any single sector. Incorporate other countries' economies. Keep enough higher risk investments, some lower risk investments. Stay abreast of changes. Things do not stay the same, so reconsider positioning holdings after thorough research. Take time to get adequate observation points before you step. Amidst all this uncertainty, some things are certain. We know we'll innovate our way out of this virus, and that our economy will shift and settle. Regardless of your opinion on how we've handled COVID-19, our government has done a fairly decent job of handling the economy, and we can expect that to continue. You know I'm going to say this, but as a financial planner, we need to look long-term, see where we are now, and plan our path. For investments, for retirement, taxes, insurance, estate planning, college, and cash flow. Having a plan, knowing that we'll fine-tune it as we go, is key.